I'd like to take a look at the dividend allowance change announced in the autumn statement. We know that the dividend allowance currently standing at £2,000 will drop to £1,000 from the 6th of April 2023 and then drop again to £500 from the 6th of April 2024. The rates of tax payable on dividends received in a year over and above those allowances, or that allowance, will be 8.75% if the dividend falls within the basic rate, 33.75% if the dividend received falls within the higher rate, and 39.35% if the dividend falls above the higher rate threshold and into additional rate. So that's where we are. So what does that mean? I think it means a couple of things in relation to financial planning and then a little bit on administration. The first thing is it will need to be factored into that bonds v collectives decision, when that decision has to be made, when you've invested beyond the so-called tax no-brainers, because effectively it will lower the threshold. It will lower the threshold above which investment bonds are worth considering for their tax deferment and tax management qualities. So if you said now the FTSE all-share yield was 3.6%, then you'd be looking at an investment of around £56,000 to generate an amount of money that will be tax-free within the dividend allowance. Next year, that's going to halve to around 28,000 based on that, if you wanted a tax-free dividend. And a year after that, it drops again by half to £14,000. So that's one implication. I'll be looking at bonds v collectives in a little more detail in another video. Second, clearly it has to be taken into account in deciding how to take your money from a company when you're a small business owner or a business owner, whether to take it by salary or by way of dividend. If the use of that dividend allowance was important to you. The tax rates on dividends, of course, increased. We're already experiencing them this year, will remain the same once you get beyond the dividend allowance. But for those that were using the dividend allowance and factoring that into their calculations, that also will need to be taken into account. The other thing that needs to be taken into account, of course, is the administration. If you are someone who has a self-assessment return and completes it, then you would have to insert your dividend payments received into that self-assessment return if they are an amount of at least £10,000. If they're below that amount, then you can include them in the self-assessment, but you don't have to, and you could report them, especially if you don't have a self-assessment return form. If you do, you're going to include the dividends in that self-assessment return form. But if you don't, and they're less than £10,000, then you don't have to request a self-assessment form, but you do have to report them to HMRC, probably on a real-time basis, getting, doing what you need to do through the government portal to report dividends. So there's an administration aspect to it too. So there's three things to take into account, relatively small, I suppose, when you look at the whole scheme of things, but something nevertheless to take into account when considering the impact that the reduction of that dividend allowance has on financial planning decisions.